If you were to design an ideal portfolio for an average client, and I know it's different for different people, but if we were to do it that way, under the current landscape, which is at best volatile, at its worst very, very shaky, what is it that's coming? Fixed income, listed equities, private equity, alternatives? How do you kind of decipher it currently?
So at Waterfield, fundamentally, of course, every client is unique. We don't have a more generic asset allocation or risk allocation. What we look at is a very customized approach. But I will take you through what is our thought process.
Sure.
So the first is really, we pioneered the concept of risk allocation. So typically when a client has a portfolio, you have to first take out the money which they'll be using for their day-to-day expenses, what they'll be using for any kind of liquidity needs. It could be buying a home, it could be setting up a business. And we take that out, and then we're left with this core investment portfolio. The core investment portfolio, we then bucket into risk pools. So you have the concept first of a conservative pool. The conservative pool is really in the event of a Lehman-like crisis, or let's say what we went through in COVID, that's a part of the portfolio that you never want risked in any way. So you're really taking care in terms of the fact that there is very little credit risk and the principal is largely protected. Your choice of products then is more around your fixed income products, which is around, let's say, fixed deposits, tax-free bonds. That will invariably comprise about 10 or 15% of a client's portfolio.
Oh, okay. Not very high.
Not very high. And then at the other end, you'll have the very illiquid assets, which is what we call our growth pool, which is all into private equity, venture capital, alternative investments, which are really for the long term. 7 to 10 years of investments, illiquid in nature, will give you typically returns in the region of about anywhere between 18 to 20% post-tax, post-fees. And then that will again be close to about 10 or 15% of the portfolio. What's then left is what we call the market pool. The market pool is really where the asset allocation starts. So you have risk allocation first, and then the asset allocation below that. That asset allocation, what we see in, let's say, in an environment today, because when you're talking about millionaires and billionaires, they really don't have a liquidity need as such. They are ready to ride through volatility. Volatility, in fact, is their friend. So they will actually have a portfolio in that market pool which is a little bit more biased towards equities, because they will see corrections in markets. They will say, hey, this is an opportunity for me to come in. And we see that in that market pool, almost 70% could be in public markets, in equities. You could have maybe another 15 to 20% which is sitting in equity, in a fixed income. And then you'll have a portion which is sitting in commodities. Because if you look at the entire pie, we've already taken out 15-20% in this conservative pool, which is fixed income. Sure. You've taken out another 15%, which is in your private equity, and everything that's left behind is largely into equities and fixed income and a little bit in commodities. So if you were to dissect that really in terms of asset allocation, by and large, it'll come to around 50% in listed markets, 30% in fixed income, another 15% sitting in alternates, and about 5% which is sitting in commodities-backed or real estate-backed investing.
And does that largely stay this way, or has there been a lot of volatility in that in the last 24 months at least?
Interestingly, one of the things that we can learn from ultra-high net worth millionaires, billionaires, is the fact that they are very, very focused and disciplined about their strategic asset allocation.
Okay.
If they are making money on equities and the equity allocation has gone up and it just crossed what is their strategic asset allocation, they will book profits. Likewise, if they are underweight, they will add to the market, because they know that ultimately it's about riding through the volatility, riding through the cycles when you're actually investing. And that's something that I think all of us can actually learn in terms of the discipline that they bring when they actually make their investments. I think one more important factor that they look at is inflation. Today we hear worldwide how inflation is just going through the roof, spiraling out of control, and all the central banks are trying to do their best to tame that. It's important that when you're investing, you also look at inflation and are your investments actually meeting and exceeding inflation? Because otherwise, the purchasing power, your money is not growing. So very important for investors to also look at inflation when they're making their investments.